Close U.S. employers added 223,000 jobs in May, helping lower the unemployment rate to the lowest point since 1969. In a protocol-defying step, President Trump hinted at the good report in a morning tweet. June 1. Will rising long-term interest rates impale your future? A poll of financial professionals shows they think rates will keep rising, believing the Federal Reserve's hikes will push long rates up. But that isn't how it works. I learned very young that any forecast that professionals agree on is exactly what is already pre-priced into markets. The good news is that bond rates will remain tame. The bad news? Don't hope for high bond returns anytime soon. Whether mortgage rates, corporate bonds or tax-free municipals, they all wiggle based off gyrations in the 10-year U.S. Treasury rate. And, yes, those rose almost 0.5% this year to 2.96%, peaking May 15 at 3.12%. That's about all she wrote. They're now around the level of Feb. 21 plumb out of steam. More money, $1 Long Island iced teas? Yes, and more Sunday deals for National Iced Tea Day. More money, rural malls hit hard times, leaving shoppers adrift as more stores close. More money, quick make an offer. 5 cities where homes sold the fastest, and the 5 slowest. My May 6 column briefly touched on what mostly drives long rates: variations in inflation expectations. Most pundits misunderstand inflation, thinking it comes from low unemployment and rising wages. No, my November 5 column explained it comes from fast rising money supply. Too much money chasing too few goods and services. If the broad quantity of money doesn't grow far faster than our economy, we don't get intensifying inflation, or long rates. First, consider the real rate, what lenders require to be compensated for foregoing cash long-term, except for inflation's effect. It hardly wiggles, except in a crisis, and approximates GDP's real growth rate, roughly 2.5%. There is also an inflation premium on top of that real rate, which is the extra needed to compensate lenders' collective future inflation fears. That portion wiggles wildly as inflation expectations gyrate. It's most of the variation in the combined rate. Without real escalating inflation, which requires excess money growth, inflation expectations can't wiggle too far. To see if money supply is jumping or slumping, first note what money is. Paper and coins, of course, but much more: bank deposits, short-term commercial loans, treasury bills, money market accounts, everything of stable value, broadly exchanged and liquidated easily, fast. It's officially called M4, the broadest money measure. M4 grew 4.6% in the year through April, slower than most of 2016, when inflation flatlined. M4 is overwhelmingly created solely via bank lending, when the banking system increases net outstanding loans. Zooming M4 requires booming bank lending. Here's the trick. Banks use short-term deposits as the foundation to finance long-term loans. The amount long-term rates exceed short-term rates determines future banking profitability from lending, their profit spread and basic motivation to lend. The bigger that spread, the more they lend. And vice versa. When our Federal Reserve raises short-term rates, like now, it shrinks that profitability. So bank lending slows, M4 growth slows, and inflation slows. And long rates bounce around, going nowhere fast. The more short rates are hiked, the more long rates won't rise, or may actually fall. Of course, it's a global world. What matters most is global money supply, inflation expectations, and long to short rate spreads. But global rate spreads have fallen slightly since last year. Hence global lending and money supply have grown modestly. America's M4 growth likely parallels that global reality. So there's no escalating inflation. Folks are wacky wrong worldwide on long rates regularly. Read hysterical stories on Italy's political gyrations and supposedly catastrophic debt. But it works there like everywhere, basically. If Italy's debt were truly problematic, wouldn't its 10-year yields be miles above ours? But as I write, they're basically identical to America's. Why? Modest money growth, same saga. And, as I detailed last week in Il Sole 24 Ore, Italy's top business paper, the country's debt is in its best shape in decades, and manageable. Still, when Italy can borrow as cheaply as America, the world must be in vastly better shape than rate doomers deduce. And fear of a false factor is always bullish. Fears don't get much more false than today's rising rate phobia. Ken Fisher is the founder and executive chairman of Fisher Investments, author of 11 books, 4 of which were New York Times bestsellers, and is No. 200 on the Forbes 400 list of richest Americans. Follow him on Twitter at Kenneth Fisher. The views and opinions expressed in this column are the author's and do not necessarily reflect those of USA Today. Read or share this story. https://usat.ly/2mbsjnt